Good morning from Yahoo Finance's New York City headquarters studios. I'm Yahoo Finance executive editor Brian Sozzi. You are watching Norwegian Cruise Line sailing into the New York Stock Exchange to ring the opening bell. ArcBest getting things underway over at the NASDAQ. Now, the rose-colored glasses remain on for investors to start the week, but maybe they shouldn't be when taking a look at the potential minefields out there over the next 5 days of trading. Government shutdown could happen on October 1st if Republicans and Democrats can't reach an agreement on funding. And for the first time since taking office in January, President Trump will meet with the big four congressional leaders at 3 p.m. today at the White House. At the same time, a government shutdown could delay key economic data releases, such as Friday's jobs report. Even if we do avert a shutdown and get that jobs report, it could easily continue a stretch of weak readings on employment. So don't be afraid to put down those rose-colored glasses for just a moment or two. All right, let's head down to NASDAQ and check out with Yahoo Finance senior reporter Ali Canal to see what's hot in the markets. Ali.
Hey, Brian. Well, it looks like stocks are opening in the green today. So traders looking through a lot of those risks to a government shutdown. We know if history is any indication that usually doesn't have a long-term impact on stocks, but we could potentially see some volatility if we do not have that non-farm payroll report hitting on Friday. If the government does shut down, we will not be seeing that jobs report, which we know has been so crucial when it comes to the possibility of future Fed rate cuts here. But looking across the board, you're going to see your gains led by the tech-heavy NASDAQ composite. The NASDAQ struggled a bit last week, so nice to see a bit of a pop there, up roughly 0.4%. The Dow was up around 100 points, and the S&P also up around 0.4%. Now, in terms of some of the tickers that are trending on Yahoo Finance, no surprise to see Electronic Arts at the top there, up 5%. This comes after the video game maker is set to be taken private in a record-breaking $55 billion deal. This is the maker behind Madden, Battlefield, and The Sims. It was also going to end the company's 36-year run as a public firm if the deal closes. So that's one stock to watch. We are seeing shares up 5%. You also are seeing cannabis stocks on the move. You have Tilray up over 28%, Canopy Growth up 13%, and Soz. It's been a minute since we've talked a lot about these cannabis companies, but these stocks are jumping after President Trump shared a video on Truth Social touting CBD's benefits for seniors and comes on the heels of his call to also reclassify marijuana. So in addition to the three major indexes in the green, you also are seeing some very significant individual movers here as well.
Yeah, really. And now, fun fact, the only publicly traded video game publisher will be Take-Two Interactive, maker of Grand Theft Auto. Strauss Zelnick, the CEO over there. Not sure what he's thinking. Ali, thanks so much. Appreciate it. All right, here's what I'm tracking right now. Government shutdown risks to a hot stock market. The prevailing mood is that the markets would handle a potential October 1st government shutdown in stride. But is that entirely correct? Over the last 30 years, government has shut down only 5 times due to funding issues. The longest was 34 days under Trump's first term. In that event, the S&P 500 initially fell by 2.1% and then, of course, recovered. And what about the economic impact from a shutdown? If a shutdown occurs, Goldman Sachs said today it would likely result in the furlough of around 40% of federal employees. That equates to around 900,000 workers. The key September jobs report set for release this Friday would also be delayed. Considering jobs data has been weak, the last thing the markets need is a data delay. In diverging views, despite government shutdown risk, Goldman Sachs is out this morning talking down the concerns the market is in a bubble. In fact, it raised the outlook for stocks. But at the same time, gold prices have hit fresh records because of government shutdown risk. Who said investing was easy? Not this guy. Here on the opening bid roundtable, Tom Essay, 7th Report Research founder, and Yahoo Finance senior reporters, Ali Canal and Inez Ferre. Tom, good to see you here. I think the market is really poo-pooing the government shutdown risk to the economy and stocks. What say you? Do you have a different take on this?
Good morning, Brian. I don't, in so much as I don't think that if the government shuts down, we're going to see stocks fall in reaction to it. But I do think it would muddle the outlook, which is pretty positive, into year end. And here's why. There is already a lot of debate over the validity of the labor market data. If you have a whole bunch of federal workers furloughed or laid off and then come back on, we're not going to see a clean jobs report probably until early December, which then complicates the whole question of what is the Fed going to do in December. So it's not so much about the government shutdown itself. It's about the fact that the market wants clean data to try and figure out what the Fed is going to do. And this would substantially disrupt that.
If one has been a bull Tom, to your point, not that you want to root for a government shutdown. That's chaos. I mean, you want people to get paid, you want the government to function, but in your view, does it raise the prospects of another rate cut?
I don't think it does. I think that it essentially puts everything kind of frozen, right? Which is actually beneficial to stocks. So the market wants to go higher. It's optimistic. And if you don't have any data that forces it to be another way, then the sort of path of least resistance will be to grind higher. My concern would be the market gets super excited about a December rate cut, and all of a sudden we get a bunch of jobs reports that are going the same direction as the previous several jobs reports, and now all of a sudden we're offsides, makes for a bumpy end of the year.
Ali, I'm not sure we want to see Friday's jobs report. I mean, the consensus right now is 45,000. That would be on top of 22,000 in the prior month. And of course, the last jobs report, we had some pretty severe downward revisions.
Yeah, all eyes are on jobs. The Federal Reserve is clearly worried about the labor side of its dual mandate, and that is boosting those odds that we will see yet another rate cut in October and then possibly another in December to round out the year here. But overall, when you parse through a lot of this Wall Street commentary, the general consensus is that the economy is in a good place. Strategists expect only a modest drag on GDP if the government shutdown takes place, and the long-term impact on stocks, like we've been discussing, fairly muted as well. At least that's the expectation. You mentioned how Goldman Sachs expects about 40% of federal workers to be furloughed starting October 1st if we see that shutdown. But the benefits and tax collection will continue. Evercore ISI pegs the odds of a shutdown at 70%, calling it, quote, ugly politics, not lasting damage. Analyst there, Julianne Emanuel, noting that stocks usually rebound once funding resumes, historically rising about 3% 1 month later there. So really the volatility driver will be if we do not see that jobs report, because like Tom was saying, we need clean data. The jobs data already has been muddied. We've seen significant downward revisions. So we want to make sure that we have the most accurate picture of the labor market before we see those rate cuts. That's something that the market wants to see, investors want to see, certainly something the Federal Reserve wants to see. But it looks like in the interim, that's not going to affect the record rally that we've been enjoying over the past few months.
Inez, every day we wake up, we talk about a potential bubble in markets, notably with AI. You know, we're seeing bubble activity? Gold. I'm calling it here, Inez.
Gold has had a massive rally this year, Brian, yes. And look, this whole government shutdown talk also is fueling gold higher. I mean, you've got gold that's been higher because of the Fed easing, but also now we have this potential of the government shutdown. So you're seeing gold going higher. Silver as well. I mean, silver has been a massive outperformer this year. But look, gold, the Wall Street, yes, it may be overextended right now, but Wall Street is still saying that gold has room to run. You mentioned Goldman Sachs. They're expecting gold to go to 4,000 by mid-2026. You have the massive central bank that's buying. And year to date, right now, gold has made 38 all-time highs this year. That is massive. You also have, as I mentioned, central banks. But look, there's been also a graph that's been circulating through Twitter as well, that central bank holdings have topped U.S. Treasuries for the first time since 1996. And in today's terms, in today's value, the U.S. reserves for gold has now topped $1 trillion in today's value.
I guess, Tom, make sense of this move in gold for us. Is it something, if you're not long gold, do you get long gold here, hoping that it breaks 4,000?
Yeah, I'd be hesitant to do that. Gold is very volatile. It's going to give you an entry point that's going to be better than buying it at the highs. But I think that the fact that gold is rallying really makes a lot of sense. I mean, if I, at the beginning of the year, were to write you a script for what could make gold go higher, it would be a weaker dollar, general geopolitical instability, confusion over U.S. trade, and general domestic policy, which is making people sort of shun traditional investments and go. And it's not just gold, right? Bitcoin, I know it's dipped recently, but that's been trading well also. And then sort of consistently elevated inflation. I mean, this is the environment where gold should be doing well. It is doing well, but like all things, and especially gold because it's volatile, it can't go straight up forever. So I would not be chasing gold here. I would wait. It'll give you a better entry point.
When do you think, Tom, we will start to see tariff impact? And I bring this up, I'm talking to Joe Livornia very shortly too, counselor to Treasury Secretary Bessent. I have not seen really tariff-related inflation in various economic reports. Like, we've been waiting for it really since April Liberation Day.
Yeah, I agree. I think we've all been surprised by this. But if we think about the actual impact of the tariffs, it really has only now started en masse because of the massive inventory accumulation. I think we're going to see it more around the holiday period and then further into 2026. The data is obviously one place to look, but also, in our personal lives, I don't know about you guys, but I'm not seeing the effect of the tariffs either, and I'm looking, for things that we buy every day, for things that may be impacted by tariffs. We're just not seeing it yet, although I would be very hesitant to caution against people thinking that means it won't show up. Over time, it will. The companies will get squeezed. They will have to pass on some of these costs at some point.
Ali, it has been amazing. We haven't seen tariffs feed through to the economy just yet. I mean, I guess it's a good thing, leaves the door open for more rate cuts.
Yeah, possibly. And on the inflation front, look, we haven't seen a massive reacceleration, which was the expectation once the tariffs were first rolled out. But we're not necessarily seeing a deceleration as well. We're sort of just stagnant. So in a lot of ways for the Fed, inflation is not moving in the correct direction. It's not moving in the wrong direction either. And that makes their policy kind of duality of what they do moving forward that much more confusing and convoluted. And we have heard from several Fed officials that they are still concerned about inflation. We are still significantly above the Fed's 2% inflation target. And based on the latest projections, we're not going to get there until possibly 2028 or beyond. So that's not something that the Fed necessarily wants to see. But again, they are greatly prioritizing the labor market. They want to make sure that that remains steady, that we don't see a significant rise in the unemployment rate. We're not at the point where the jobs market is falling off a cliff, but that is certainly the biggest risk at the moment, especially with the immigration crackdown currently underway. That's affecting various sectors and really the supply and demand dynamics as well. And the Fed is trying to understand what the longer term impact will be for that type of policy as well. So there's just a lot of things that the Fed is currently juggling, but the inflation side has been better than feared in a lot of ways, but it's still not at the level, I think, where the Fed would like to see it at this point.
And against this backdrop, Goldman Sachs out this morning going overweight stocks, which is the equivalent of saying buy stocks even though valuations are still quite high. All right, thank you to my panel today, Tom Essay, Ali Canal, and Inez Frey. Appreciate it, guys. All right, straight ahead, Dell gets slapped with a Show Me Story label, and I am joined by a key member of the Trump administration's economic team. We'll be right back. Welcome back to Opening Bid. A call on Dell by JP Morgan analyst Samik Chatterjee has caught my attention. Chatterjee says Dell is a show me story headed into its October 7th analyst meeting. While the analyst thinks Dell will lift its long-term financial targets owing to strong demand for AI infrastructure, the market already expects this. Chatterjee wants to see more progress from Dell on margins before becoming even more bullish on the name. All right, stock market continues to reach new records on the back of strong corporate profits. The economy, though, is a little more mixed. On the one hand, second quarter GDP increased 3.8%. The U.S. consumer powered that increase with spending up 2.5%. Yet reads on the labor market have been weak. The August jobs report showed employers added only 22,000 jobs, far below estimates. The unemployment rate rose to 4.3%, the highest since October 2021. And economists only expect an increase of 43,000 jobs for September. That report is expected Friday if lawmakers avert an October 1st government shutdown. Let's talk more about all this with Joe Livornia. Livornia is a counselor to Treasury Secretary Scott Bessent. Joe, good to see you. It's been a while. Thanks for kicking off our week here.
Thank you, Brian.
Make sense of this economy. Like I just mentioned in the intro, you had GDP, I think surprised a lot of folks out there, almost rise 4%. You got a labor market not breaking 100,000 non-farm payroll increases anymore. How do you see things as we stand here right now?
President Trump and Secretary Bessent, Brian, are certainly not surprised by the very strong near 4% growth in the second quarter, which was the president's first full quarter in office. The key thing about the labor market is we know now with revisions that the Biden economy was not particularly robust, roughly 1.5 million in downward revisions over the past year or so in light of what was first reported. So the handoff to this from one administration to the next shows a much weaker, fragile economy. The good news, of course, is that President Trump has passed the One Big Beautiful Bill with the help of Secretary Bessent. That will put a floor under growth, and we're seeing a big CapEx come back, a big surge in investment spending because of that bill, which is retroactive, Brian. So the forward on the outlook is excellent. And I like to highlight the fact that the widely followed Atlanta Fed GDP now, following last Friday's very strong consumer spending report, has growth up near 3.9% in the third quarter. So it looks to me like despite the weak labor market the prior administration gave us, top-down GDP looks great.
So the 22,000 increase for August, Joe, we might see, let's say, 45,000 economist estimates for the upcoming report. You think that is the floor? These are some of the lowest numbers we might see this year?
I don't know, Brian, if it's the floor, but I know last year, right before the election, the Fed cut 50 basis points when the trend in headline jobs at the time was 116,000. Now the headline trend in jobs is just 29,000. And that reflects, I think, President Trump's frustration that rates need to come down. Fortunately, the Fed has moved in that direction, and policymakers have highlighted that rates are likely to come down further. So if you have rates not a headwind to growth, then certainly you could see the labor market turn, because one of the risks, of course, is that interest-sensitive spending in areas such as housing are vulnerable. So we're hopeful this is a floor. But again, the good news is we've put in place tax regulatory policies. We've got low energy costs. All those factors should propel the economy much higher, not just in terms of the great GDP we're seeing, but also this labor market hopefully being a soft patch and growth accelerating sharply in 26.
3.8% GDP growth, Joe. Should investors view that as the pace moving forward over the next couple quarters?
Certainly, Q3 looks like it's going to be up near 4%. 3% was the growth we had roughly in President Trump's first 3 years. Growth was just under 3. The third year growth was almost at 3.5%. So a 3% number does seem very reasonable to us. As Secretary Bessent said last fall, early winter, that 3% economy is very doable. And that matters, Brian, because a 3% economy is going to generate revenues and put this economy on a much more solid fiscal footing, having run historic, unprecedented deficits over the past 4 years in an environment with full employment.
So do you see, against that backdrop, the job market reaccelerating in early 2026? And what is that reacceleration? Yes. What would that even look like?
So we do expect the job market to reaccelerate, and the fact that jobless claims have moved back down is very encouraging. What we expect to see is the broadening out in hiring, financial and professional services, manufacturing employment accelerating a bit, construction employment accelerating a bit, retail, wholesale trade, transportation services. The whole shebang, if you will. We should see broad-based job growth as the economy is generating this fast growth. You're going to see multiple of industries higher. That's what we'd expect to see. That's what's in store. But again, the U.S. economy does need some help on the interest rate side, because the 3% plus growth is great right now, but we're not going to sustain that if monetary policy, by the Fed's own admission, is working to restrict economic activity. In other words, monetary policy interest rates cannot be a headwind to growth, because we won't meet our full potential and the labor market will not improve as much as we think is likely. 3%
GDP potential. You're talking here, Joe, about a reaccelerating job market. How many more rate cuts against that backdrop, which to me seems pretty good? How many more rate cuts do you think are necessary?
Well, neutral rate, the Fed has the neutral rate around 3%, and the funds rate right now is still above 4%. President Trump, of course, wants yields to fall significantly lower. I think we need to see what the data look like. I was listening earlier, there's been no tariff effect. I know the fact that we're still looking for it in the numbers suggests that even if it shows up at some point, the effect is going to be relatively de minimis. And that was one of the main reasons why the Fed has been slow and cutting rates, is they've been worried about a tariff effect, which simply has not shown up and is not going to lead to higher inflation expectations. So we'd expect rates to come down quite significantly. We'll leave it to the Fed to figure out where that level is. But again, all of their internal estimates suggest that rates are still much too high relative to where they are at the moment.
And Joe, there's still a contingent inside of the Federal Reserve that is really, they don't want to necessarily go out there and cut rates gangbusters. And I look at what Cleveland Fed President Beth Hammack said this morning, suggesting that inflation might be around to 2028. What do you think about some of her comments?
Well, the thing is, energy prices have come down quite significantly. We've seen food prices moderate. We know rents are coming down. Inflation is a lagging indicator. Since President Trump has been in office, we've seen virtually no increase of any meaningful increase at all in goods prices. We've seen the impact on the services side, but we do expect service prices to moderate. I mentioned housing. Housing affordability itself is at record lows. That's one of the reasons why we like to see interest rates come down and make it more affordable for people to buy homes. But we don't really see any inflation effect right there, where it's a worry. And the markets as well are not signaling there's any inflation effect. If you look at break-even inflation, five-year forward inflation expectations, none of those things, Brian, suggest there's any inflation problem whatsoever.
The Fed chair last week, Joe, had a lunch, made a few comments, and my interpretation was that he pushed back on the need to come out here and aggressively cut rates. Is the bottom line that we just need to see a change in who is leading the Federal Reserve to get the rate cuts that you want?
Well, the thing is, the Fed historically has been very slow in cutting rates, which is why the economy could look really good and all of a sudden it tips over. And that's the comment the president has made, but it's consistent in the academic literature. And that's why, when some people on the FOMC or one of the reserve banks, as you mentioned, President Hammack, you have a situation where inflation is telling you what the economy was like some time ago. You had very robust government spending under the prior administration. This administration is slowing government spending and trying to get rid of the waste and abuse, trying to create a more efficient system. That itself should free up resources and lower the inflation rate. So if you're looking at the inflation rate now, as Milton Friedman famously said, it's like driving your car looking in the rearview mirror. You need to look at forward-looking indicators, and those forward-looking indicators, and when you look at credit spreads, financial market expectations of inflation, all those things just do not suggest, Brian, there is an inflation problem. So we're hopeful the Fed will move in the direction of lower rates. They have cut. We expect them to cut again because they basically made that commitment. Historically, when the Fed does cut initially, they cut more. We'll see what happens.
From your seat inside of Treasury, Joe, will the administration signal to markets who is likely to get this job before year end?
Secretary Bessent has come up with we've got a list of 11 people, all highly qualified. The secretary is working through those candidates. In due course, he will give those to the president. They'll be whittled down to some number. I don't know what that is. And then the president will make a decision. I can't say whether it's going to be in December or next year. That will depend. And as you know, there are potential other Fed governor positions open. So the administration will have to potentially fill those seats as well.
Always great to get some time with you, Joe Livornia. Don't be a stranger. We'll talk to you soon.
Yes, I was going to say the same. Thank you, Brian.
All right, appreciate it. All right, coming up, Julie Hyman has you covered on Market Catalyst. Don't go anywhere.